Welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook, and I'm going to be your host here for about the next 30 minutes. We might go a little long today. We have a lot to cover here on Options Guide TV, mainly because we have a few short-term trades going on, and I do want to look at a trade in Costco as we head into earnings. We got a lot of retailers that are going to be announcing today, or over, I guess, going into Friday is a better way to say it. This morning we had Foot Locker that announced earnings, and then we have BJ's, we have Macy's, we have Costco. There's a few others that are in the Gap is actually announcing on Thursday after the close too. So we're going to get a lot of information on the consumer. Target announced earlier in the week, didn't do so well, showing a little bit of weakness. Feel like Walmart is eating their lunch, and Walmart is the darling of this space right now. And we'll see what Costco has to say about it is the way that I look at it. But the one thing I like about Costco is that it's $1,000 stock that announces on a Thursday after the close. So all you have is 1 day for the Friday, March 7th option contracts to live. So we're going to look at that trade, but let's not put the cart before the horse. Let's go in and take a peek at what we got going on in IWM. So in this scenario, in IWM, let's go and run to the Tradier Pro software. I have it already set up inside the what if calculator. And we put this trade on with 30 days to expiration. And now we're looking at the March 7th expiration. We've had the down move in IWM. So when we put this trade on, the stock was right just below 217. We bought just in the money put option. And then we sold the 203 strike put, and we were able to do this trade for $3.50 or $350 per 1x1 long put spread that we put on. So you can see inside the what if calculator that the market has made the move down. It's trading at 206 right now. So it's down $11 from where we put the trade on. I'm going to add this to the trade ticket. And we now see this trading for about $8. So the maximum that it can trade for would be $14 if it got all the way down to the 203 level by the March 21st expiration. So usually if I'm doing a long put spread and I get a double on it, I'm going to want to get out of the trade. So we put it on for $350. We can close it for close to $8. This would be the rule. So you do it. Now, if you had more than one on, if you ended up with, let's say you did 3 or you did 5, I don't mind letting 1 or 2 of them ride. But in this instance, if I'm doing one by one bear put spread, then I'm going to close it because that's what we do. So right here, we're at $8 and the way that we close that trade, and I'm going to take it off my list. I'm going to say that we're going to move on. So I'm no longer going to come back and look at this trade anymore. We're going to, the buy to open would be a sell to close, and the sell to open would be a buy to close. And you do it for a net credit to the account of around $8. Move on from that trade. That trade's done. Long put butterfly trade. Okay, so I'm going to set up a trade just in case somebody wanted to do a rinse and repeat with this. The market is tough. It's once again, it's driven more by news headlines right now than it is by fundamentals. What's coming out of Washington and what may happen next. So now there's another, another representative of Washington saying that the tariffs might not hold, that they might be removed sooner than later. And that's made the market go back up. So it's really all about news headlines. We do have numbers coming out at the end of the week. On Friday is the jobs number. Let's see exactly what Friday, we have non-farm payrolls, and we also have the unemployment rate. So those are going to be, pretty big. And not to mention the fact that the big question mark is the consumer. So Costco is going to be, they usually will make some comments in their conference call about the strength of the consumer. And then like I said, BJ's, Macy's, there's going to be a lot of information coming out. Even Kroger's on the grocery side of things will be an interesting conference call to hear about where they see food prices going forward. So the information isn't necessarily about how I do expect Costco to come out with strong earnings. I expect that, but it's really going to hinge on their forecast afterwards and what they say in the conference call. So to me, that's a lot of news because the consumer is the topic right now. Are they going to slow down their spending? All last year, the consumer kept the market strong. Even though a lot of people were complaining, saying the economy was bad, they were still spending. So it was a little bit of an oxymoron situation that was going on last year. This year, we're now actually seeing the consumer actually weaken, and that will weaken the market overall. And then people get nervous, and you've already heard the R word come up a couple of times from some of the pundits that are out there talking about the financial system. But I think it's a little way too early to be thinking in that direction right now. Just because the market's down in general. All right, so here we go. Long butterfly. The trade that we put on Monday, the market was up around the 59.45 level. And I did on the show have the wrong expiration to start with. I made sure that I have that correct now. So the market is here. The market is now here. So this is trading for close to the maximum that you can get for the trade. Now, this profit and loss graph is as of today, and it's showing you that the zero line is right here. Now, we didn't pay $5 for this butterfly. We paid $2.50 for the butterfly. I think that's the number that I had that was in there. And yeah, it was $2.50. And so if I send this to the what if calculator, we're going to be close to $5. We still got a lot of juice in these option contracts. So let's send this to the ticket and let's look at the actual chain in the SPX. And we'll come back to Costco in a second here. We got the March 7th expiration. These are our option contracts. And you still see there's some time premium, right? So just by looking across actually I have the intrinsic value right here. You see that these option contracts, even though they're $100 options at this point in time, still have extrinsic value or time value of $9. Now, when you're correct on your forecast, you want time value to go away. You need time value to dry up. So this won't max out until you get closer to the expiration date. Now, the way the markets are, as a matter of fact, the market was just up and now we're down. Like literally that just, the last time I looked at it before we kicked off the show, the market was up 7 and now we're down 12. So the volatility is there and the VIX is showing it. If I scroll down and take a peek at the VIX, we're seeing that the 20 level in the VIX is, the new 15 level. Basically, the last about 9 sessions, we've been hovering around that 20 level, just showing the uncertainty that's in the marketplace right now. But if we look at this trade, saying $5, yeah, that's not. We can't fill for $5. We're about $4.50. You know what I would do is I would take this trade for sure and have a trade in, flip the script. $5 mean that's the max. That's what it should trade for. That's the maximum that you could get for the trade. So we'd flip the script and let me do that. I'm going to have to hit open instead of buy or instead of close. And that's mainly because this is just a paper trade, or I'm using a test account. Let's put it that way. and then we sell. Okay, so it's saying a net credit of $5. They're not going to that's like giving you wholesale prices. So 470 is not a bad, and I would take it off for 470. You're going to give up 30 cents on that trade to get out now and not wait until Friday. And we're still quite a bit away, right? 59.10. We're more than, we're about a one because we're right on the gray. So we're about a one standard deviation move away, which could happen, obviously, in this marketplace, meaning that the marketplace still could come back. Now, if it does come back and it actually goes beyond the 59.10, that's actually not a bad thing. We just don't want it to whip all the way back and go past the 59.45. That's where we would be at a loss. So anywhere inside here, we're still within the butterfly, and our max upside is actually at 59.25. Okay, so with that said, I would have a limit order in right now for 470 net credit to the account, and that's how I would try to get out of the trade. Now, if it confuses you why I'm centering around the $5 thing, it's that we did a 20-point wide long spread in our butterfly, and then we did a 15-point wide short spread, and you're literally just doing the math. The upside trade, the trade that benefits us the most from the market going down, is worth 20. And the downside trade, the trade that we sold to pay for the long spread, that is 15 points wide. So that means the maximum that this can trade for is $5. And you're not going to get $5 right now. So you can put it in there all day long. They're just not going to fill you and not take any vig. I mean, you could try to get 495 and maybe work down to 470. But the other thing that's nice about the SPX, and part of the big reason why I like to trade it above and beyond the SPY, the SPY is much more transparent in their markets because it's a smaller index, and the liquidity is like it's the most liquid listed option contract out there. So you're getting penny wide spreads, which in the SPX would be a dime wide because it's times by 10, right? But if we get to expiration, if you rode this all the way to expiration, the SPX, the actual index, is cash settled. So this would be one that if you don't want to deal with bid-ask spreads and you made it all the way to expiration, there's still a risk the market could come back. You just let it settle into cash in your account. The Options Clearing Corporation would exercise what needs to be exercised and assign what needs to be assigned. Everything is in the money, and you would just end up with cash in your account on Monday morning when you came back and logged in to your account ready to trade. And actually it happens quicker than that. Back in the day, that's the way it used to be, but you'll see that cash in your account usually on Saturday morning, depending on your broker and how quick they get things done. Okay, so any questions on that trade? I got to remember to take a peek at that. And if you have any, please do put them in the chat box and I'm happy to address them. All right, now I decided to toss in an extra one of these. And the main reason why, and one of these, I mean, open wing butterflies, is that the VIX is so high that we can still get it done for a decent price on a Wednesday. Now, we're not going to be able to adjust the trade on the show. And that's part of the reason why I like to put them on Mondays, because we got a Wednesday show. We could make an adjustment and head into Fridays. But in this trade, in this situation, if you're going to adjust it, you're going to have to do it on your own. And here's the way that I would set it up. Once again, market's at 57.77. Yeah, wow, that's a fun number. 5,777. And I did have the market higher before, so the market has flipped around. So I would adjust this down $5. I guess I can do that. Yeah, it's already trading for too much money. All right. It was about $3 when I looked at entering this on the show. 57.77. Let's send it. That's not to trade. Let's take this, send this to the ticket. 57.80. We'll have to make this 57.75. Yeah, that's where we would be. 57.75. Pain in the butt doing live shows sometimes. 57.75. 57.55. And let's hopefully we get this down to about $3. 57. 15 would be 40. 57.40. Okay, so this should be 20 points and this should be 15 points, and it's about $3. That's exactly where we're at. Okay, when we put our trade on Monday, we did it very close to where this is set up relative to how far out of the money our first put option is. We're only a couple of points out of the money. We put that on for $2.50, and we could have filled pretty easily at that rate. With markets like this, it's fairly easy to fill multiple leg trades close to the midpoint. Not a guarantee, but that's the way you got to trade in the S&P 500 index. And I'm going to put $3 on this, and I will copy it. But man, the markets are moving, huh? And in this scenario, we want the market to come down to 57.55. That's where we want it to land at. Oh gosh, the market is down even. I can't even get through the trade. What is going on right now? Yeah, now we're down 20. Well, gosh, if we would have did the show an hour ago, this trade would have been profitable by the time we got done with the show. I'm going to leave it at $3. We're going to leave it and look at this trade. I'm kind of surprised it's trading for 3, actually. March 7th, $3, 3.20. It's going up a little bit. 315, 57.75, and it's 55. We're right at that middle strike right now. All right. Well, I would adjust it, try to pay somewhere close to $2.90 or $3. That would be my goal. And we'll let this one ride. I need to get on to the Costco trade, and this I can't keep up. The market's now down 22. So obviously some news hit. I don't know what obviously happened, but it happened during the show. This will be a paper trade if you want to do it on your own. We talked about the adjustment on Monday. If you want to go back and look at the adjustment, that's what I would do if the market went against you and the market bounced back about 1% or 58 to 59 points to the upside. That's when you'd look to adjust and roll into the short put spread if you're willing, because it's a scary trade in this marketplace. But this is a way to do a rinse and repeat with this strategy, possibly. All right. Now, last trade that I want to talk about. If you have any questions, please do put them in the chat box. But I'm going to go back to the what if calculator. And I like this trade. I like this. There aren't that many $1,000 stocks. You had Amazon do the 10-for-1 split. You had NVIDIA do the 10-for-1 split. They were $1,000 stocks at that point in time, came down to $100. And now the stocks have ran up a little bit. But I liked it better when there were more $1,000 stocks because you can set up some more interesting trades. It adds premium. They're easier to trade, and no tight spreads are harder to maneuver than, in my mind, than in wider spreads that you can do on higher price stocks. So what we're going to do is a skip strike butterfly in Costco. They announce on Thursday after the close. You could wait till Thursday to put to set up the trade, but the trade is going to be similar to this scenario. We're going to go about one standard deviation move out of the money. And let me put in Costco. And we're going to use the short-term options. And once again, I'm doing this as an alternative to a short spread, not as an alternative to a butterfly. I'm hoping to make the net credit more than anything. We got the March 7th expiration, 2 days away. Yep, and my options are here. And this was 89 cents when I first started, but we'll take 69. I'm still okay with that. We The market is at $1,029.85. Here's the Tradier Pro software is highlighting where the market is at and highlighting about a 1 standard deviation move. And we confirm that by looking at the delta. It should be close to 16. So our risk is that it blows the market away to the upside. So it's nice to be out at about a 1 standard deviation move. And our risk kicks in at the skip strike. We're at 1,100 is our short strike. 1,120, 1,115 is our skip strike. And then 1,130 is our protection strike. We don't want the market to go beyond 1,100. We want it to stay south of that number. Ideally, the best case scenario would be that the market would open up about the expected move, which is 40, let's call it 42 points. 30 plus this is right around 172, right in this range. That's about the expected move. And we'd like it to then start drifting at the end of the day towards our middle strike of our skip strike butterfly. Now, if the market goes down, we make ours, well, we'll call it 73 cents. Let's call it 70 cents. Let's just make it 70 cents and make that our official paper trade. We'll say 70 cents, make a nice round number. And if not, we have 10 points of upside here. And then on our downside, our risk kicks in once we get beyond the 110 level. So we'd have $2,000 worth of risk on the downside if it moves more than 1 standard deviation move. It's got to move all the way up. They're saying the delta, there's an 8% chance, but it is earnings, so it could happen. But there's an 8% chance that it's going to get to that 110 strike. The only thing that really scares you on this trade is a gap opening beyond that strike. And I've done these trades on earnings, and that has happened before, few and far between. But when it does, it hurts. It hurts fairly quickly. So if you're putting this trade on and you do it on Thursday, you want to react fairly quickly on Friday. If it hits, let's say if the market opened on Friday at 1,100, you'd close it out. That simple. Just get out of the trade. Don't ask. Don't say, gee, I should be getting more of a premium on this trade. I should be making more money. Just get out of the trade because you have too much risk on the upside in this scenario. So there it is. That is the paper trade for this week. The official paper trade is Costco tossed in an extra trade on the SPX because we got out of that trade because it's already profitable. And we put it on Monday. And if you want to continue to get bearish in the marketplace, that is one way to do it. Costco, this is a bearish trade in my mind. I'm hoping to bring in that net credit of 70 cents to the account. If it does start going towards my butterfly, I just hope it doesn't blow away the marketplace and I get an opportunity to get out. But the Costco trade makes money if the market goes down. If it stays the same, kind of goes up and does actually go up pretty good beyond the expected move, but it hurts if it gets blown away. So there's only one scenario there that it hurts, but it is earnings, so it is possible that scenario could happen. All right, I don't see any questions in the chat box, so that's going to be it for this edition of Options Guy TV. Interesting market we have going on here, and definitely come back Friday to see where everything lands at the end of the week, 11 a.m. Eastern time. You can follow Options Guy TV inside the Tradier Hub at hub.tradier.com, on my X, which is at Brian Overby, inside the Tradier YouTube channel. Also, many different venues that you can watch the show. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.